Hi, my name is Tom Carter, and I'm going to introduce you to the Simple IRA plan offered by Hayes Caldwell Women's Center. This presentation is only about 8 minutes long and will hopefully answer most of your questions. I work for Retirement Plan Fiduciaries, and we are the consultant for the plan. This plan is an important part of Hayes Caldwell Women's Center's benefit package, and we encourage you to take advantage of it. A Simple IRA allows you to save for retirement. Most people understand that Social Security will not be enough for a typical person to retire on. If you want to be able to retire, you'll need to save for your own future. The Simple IRA allows you to save a little each paycheck. For those people that have participated in retirement plans in the past, you'll probably agree that after the first paycheck or two, you won't even miss it. The power of payroll deduction is a great benefit of a Simple IRA plan, as it allows us to save for our future before paying for our day-to-day living expenses. Another benefit of a Simple IRA plan is that it allows for tax advantage savings. You get a tax deduction on your contributions to the plan. Any earnings on the account will also be tax deferred, and you will not have to pay taxes until you begin withdrawing the money, hopefully in retirement, when you'll most likely be in a lower tax bracket. You can take the money out of the Simple IRA plan at any time. You should be aware that if you take money out of a Simple IRA prior to age 59 and a half, you'll probably have to pay a 10% penalty, as well as having to pay normal income taxes. One of the biggest benefits of the plan is the match. Hayes Caldwell Women's Center is committed to a match for 2014, which can be as large as 3% of your compensation. They match dollar for dollar on the first 3% of your pay. For example, if your compensation is $1,000 for a payroll cycle, and you contribute at least $30, then Hayes Caldwell Women's Center will also contribute $30. Of course, you can contribute more than $30, but Hayes Caldwell Women's Centers will limit their contribution to $30 in this example. They are basically paying you to save for your retirement. Some people like to think of this as free money, and everyone likes that. If you were employed in 2012 with Hayes Caldwell Women's Center, then you will be eligible October 1st, 2014, which is when the plan is starting. If you began employment in 2013 or later, then you will become eligible to January 1st after 12 months of employment. For 2014, you can make employee contributions of up to $12,000 or $14,500 if you're 50 or older. The match does not count against these limits. For most people, investing can be very confusing, as they do not have the expertise to invest, nor do they have the time or desire to become experts. Investing is also very emotional. This is your hard-earned money, and you don't want to lose any of it, and this is very understandable. However, in order to get a reward, like make a return in excess of inflation, you'll probably need to take some risks. A mutual fund pools thousands or perhaps millions of investors' money and hires a professional money manager to make the day-to-day decisions on which stocks or bonds to buy. Most mutual funds will own hundreds or thousands of different companies or securities, which will help diversify the risks of owning stocks. If you choose a stock mutual fund, you will own part of the company that the manager decides to invest in. If the company does well, in general, so will your investment. Historically, stocks have been an asset class that may perform well, but has high volatility and risk associated with it. Bonds are more like loans. They can also go up and down in value, but generally not as much as stocks. Cash is like a savings account at a bank. Put $1 in, get $1 back, plus some interest. Ours is insured by the FDIC. This is a retirement plan, and the longer the time horizon you have until retirement, the more aggressive you can be with your investments. Being more aggressive means putting more money in the stock market. Generally speaking, if you have more than 10 years before you retire, we would recommend some form of an aggressive portfolio. As you can see on this slide, small company stocks have an average return of 11.4% per year from 1926 to 2012. By no means does this mean that they made 11.4% every single year. Some years they may make 30%, others they may lose 20%, etc. Large company stocks have made 9.8% per year. Government bonds have made 5.7%. T-bills, which money markets purchase, have made 3.5%, and inflation's been about 3%. By no means do we recommend that you take all your money and put it in small cap stocks just because it has the highest historical rate of return. It has been volatile, as you can tell by the ups and downs of the chart. As you have all heard many times, past performance is no guarantee of future results, but the 87-year history of this chart may give us some indication for the future. In a simple IRA, you have complete investment flexibility. You can buy individual stocks or bonds, mutual funds, CDs, or just leave it in a money market fund. The plan's custodian is Schwab. For those of you that do not follow the stock market very closely, you may want to consider investing in one of the Schwab target date funds. These mutual funds are designed to be a single choice for people. They will automatically get more conservative as you get closer to retirement, which most advisors recommend. For example, if you were born in 1975, you will turn 65 in 2040. Thus, the Schwab 2040 fund may be applicable for you. By choosing this option, you do not have to worry about how much to put in large stocks versus international stocks versus bonds, etc. They make the decision for you, and it is automatically well diversified. These are perfect for people that do not know the difference between a large cap, a small cap, and a baseball cap. You can also set it up so that you invest a certain dollar amount each month without you having to proactively place the trade. Call Schwab to set this up after your first contribution is made to the plan. In order to enroll in the plan, you will need to complete the Schwab IRA account application and the Simple IRA elective deferral agreement. These need to be turned into the HR department. If you prefer, you can seal the account application prior to turning it into the HR department, as it does have some personal information. The account application can look intimidating. If you have any questions, you can call Schwab or ask someone in HR for assistance. After the account is opened, you will receive account information from Schwab via regular mail. You will then be able to access your account information on the web or telephone, and you'll also receive monthly statements. In summary, a simple IRA plan is almost without debate the easiest and most tax-efficient way to save for retirement. With the great match that Hcwc Women's Center is offering, you'd be giving away free money if you don't contribute at least 3% of your pay into the plan. Your future self will thank you for doing this. You can make trades in your account daily. However, we recommend coming up with an investment strategy and taking a long-term approach and not trading very often. Start today. Too many times I've heard people say they're going to start as soon as they pay off their car or some other reason. Too many times these people just never get around to it and then wake up one day and realize that they're 50 years old and haven't started saving for retirement yet. There is always a reason not to save, but the earlier you start, the easier it is. Thank you for taking the time to watch this presentation, and remember to take advantage of this great benefit offered by Hcwc Women's Center.